Did you know the amount of money that you can pass on to your heirs tax-free could change dramatically in just a few years? When the estate tax exemption is set to decrease in 2026, there's also talk that a new administration or Congress might extend it. But here's the thing, no one can predict the future. And with potential tax hikes on the horizon, it's crucial to have your estate plan in order now to protect your wealth and legacy. Today we're speaking with Patricia Lloyd from Ardent Wealth Management. Patricia is both a certified financial planner and a certified public accountant, giving her a unique ability to navigate both the financial and tax complexities of estate planning. She's here to help us understand what these potential changes mean and how to prepare no matter what happens in Washington. Pat, welcome back.
Thank you.
Let's start by talking about the current estate tax rules. Can you give us a quick overview of the current estate tax exemption and how it works?
Sure. We kind of got a gift from the Tax Cuts and Jobs Act of 2017, which increased the exemption to over $13 million per person. It's pretty high. It's a good amount of money, right? So most people are going to fall below that today. However, it's set to sunset at the end of 2025. So 12/31 of 2025, that number is getting cut in half to roughly about $7 million per person. And even that still seems like a decent amount to most people. But what people forget about when they're looking at that is growth on their money over time. You know, you may be below that today, but what is it going to be by the time you pass away? And then also, like, when you look historically at where that exemption has been, it has been as low as $1 million at times. And there's been a lot of talk in Congress of settling somewhere around a $3 million number. And so we're looking forward that there's probably going to be future changes that continue to happen to that number. So tax planning for that today is critical.
So yeah, now that there's been a lot of speculation about changes coming in 2026, we've already covered what the current tax law is regarding the exemption and what's expected to happen. But there's also a possibility that a new administration or Congress could extend the current exemption. How likely do you think that is? And can you elaborate a little more on those factors that could influence that decision?
I don't see an extension of that coming. I just don't, because we know we've got our deficit as high as we have it currently, and it's just out of control. And we also know that the boomer generation holds the most wealth in the country, and that wealth is going to change hands from them to their heirs somewhere in the next 10, 15, 20 years. And so they're looking for these tax dollars to help with this deficit. And so I don't really see them extending the high limits we have today of the over $13 million per person. I see them letting the cut go back to the $7 million roughly that's going to happen, and then potentially even lowering that number further in the future.
Right, because that's probably an alternative to raise revenue that's not going to get as much pushback as like an income tax increase.
Absolutely. It's a lot easier to tax wealth transfer that a lot of people just don't think about than it is to go raise taxes on a middle class person that's struggling to put food on the table.
And I get that notion that it's easy to tax dead people because they're not going to complain, and even their heirs, it's not going to be as big of a difference to them in their mindset of I'm having to pay a little bit more in taxes because you're still getting this big ball of cash.
True, in most cases that is true. However, depending on what assets somebody holds, it could be a really big issue for people. If they've got most of their money tied up in a farm or real estate or things like that, and they don't have a lot of cash, you only have 9 months to send that check to the IRS. And so in a lot of cases, what happens is people end up having to fire sell off assets, maybe in a down market where you wouldn't necessarily want to sell that building today, but you don't have a choice because you've got to come up with the dollars to be able to pay that tax bill.
Okay, so I guess that's kind of a little bit leading to the next question, but if the exemption does decrease as it's scheduled in 2026, can you elaborate more on how this could specifically impact high net worth families? I mean, you've already talked about like having to sell assets, but are there some more implications that they should think of?
Yeah, for sure. I mean, when you're talking a high net worth person, somebody maybe that has $20 million between a husband and wife. You know, they together would have a $14 million exemption, but anything above that, so there's an additional $6 million we're talking there for that particular person, they would probably be paying roughly half of that into the IRS. So I guess my question to my clients always is, would you like to have the IRS and our government as one of your heirs, or would you like to disinherit them?
Let's talk a little bit more about potential future tax hikes. Even if that exemption is lowered, why might higher taxes in the future be a concern for estate planning?
I think that they're a concern because most people don't have enough cash to be able to pay those tax bills, and nobody knows when they're going to pass away and in what year they're going to pass away. So it's trying to plan for kind of an unknown, and an unknown of what those exemptions will be in the year that you pass. But what people don't realize is that today, having these higher exemption limits, there's tools we can use to move money outside of someone's estate, using up, because what they call that exemption, it's called a lifetime exemption. Okay, so if their lifetime exemption is really high today and you've got over $13 million and we know it's going to be cut in half, we could actually preserve that difference, the roughly $7 million, by making some moves today and getting some stuff outside of the estate.
What would some of those ways be getting your wealth outside of your estate for that kind of a planning?
Well, I mean, typically right now people, you know, have all their different assets and they're maybe in their revocable trusts and things like that. And maybe they even have like a life insurance policy with a death benefit, and everybody says, oh, the death benefit's not taxable, which is true. It's not taxable for income tax purposes, but it is includable in your estate. So when you're looking at that, say maybe you have a couple $1 million life insurance policy, now you just added a couple $1 million to your estate, but you were trying to create liquidity with it to be able to pay those taxes within 9 months if something was to happen to you. There's ways to actually hold that life insurance policy outside of your estate so it doesn't get included in your estate. There's also ways to use different kinds of trusts and things along, you know, that estate planning attorneys draw up that move assets outside of your estate as well. So you could have, maybe you own a commercial building that's worth $5 million. There's ways to move that commercial building outside of your estate today and use up part of that $13 million exemption, and now it's not includable later on, no matter where the estate tax limits go.
So are certain assets or estates more vulnerable to these potential tax hikes that we were talking about before?
Yeah, for sure. I think estates that are going to be left to heirs that include non-liquid assets, meaning maybe you have a farm that you're leaving to your heirs, or you own a lot of real estate. You know, those types of things are not liquid assets that they can access money out of them to turn around and have to pay an estate tax bill with. And so it's really important when you've got non-liquid assets and you don't have enough money for them to be able to swipe that check to the IRS to give them their inheritance, which is what I call it, then, you know, that's a problem, because now you might get in a situation where you're trying to fire sale something, or even like business owners are a key one. If most of your wealth is tied up in your business, the day that you pass away, that business has to be evaluated. And whatever that valuation is what's includable in your estate. And so, you know, you might be in a situation now where they either have to try to sell a business off in 9 months. It's really hard to find a buyer and close on a business in 9 months. And so that's really an issue a lot of people are coming into, is like, what are the assets you own? What are their values? And is there going to be enough cash if you didn't disinherit the IRS and do some of this planning?
So given that uncertainty, what estate planning strategies are you recommending to some of your clients to prepare for this outcome?
Yeah, so for clients that are like business owners, for example, there's ways to move part of your ownership in your business outside of your estate today and use up the lifetime exemption that's really high right now. And so that's a lot of the planning we're doing. And there's different kinds of trusts and things we use for that. You still manage the business, you still get the income from it, you still control all the things that you control, but you're moving it outside of your estate today. And there's ways to actually get even more than the exemption by using different share classes and things like that are maybe non-voting and don't have the same rights as you do, where those would be diminished in value because of that. And those allow you to even move more money outside of your estate.
Okay. Well, trusts seem to be like a foundational tool in estate planning. Can you explain how different types of trusts can help manage or reduce potential estate taxes regardless of legislative changes?
Sure, yeah. I mean, there's definitely different kinds of trusts that are available. There's one that's called an ILIT, for example, and it's an insurance trust that you can put an life insurance policy in that would move the death benefit outside of your estate. And so rather than just buying insurance in your own name or like in your irrevocable trust name, which most people just have a revocable trust. That's honestly what most people have out there. They either have, wills or a revocable trust. No one takes their estate planning kind of to that next level where it's like, okay, yes, I have these things, but how do I asset protection for future generations? How do I protect from estate taxes from future generations? And there's lots of different kinds of tools in that toolbox to use that you can use those things and get stuff outside of your estate. And so there's many tools to use. Unfortunately, most estate tax attorneys, or not state tax attorney, but just the state attorneys that do trusts and wills and things like that, they don't actually go into the realm of how do we protect against estate taxes. They're more just looking at, okay, I'm going to do wills and trusts and things like that. The typical stuff most normal people have in their lives.
So they're more like builders as opposed to designers.
Correct. Yes. And so my team that I work with, I've got great estate attorneys, but they also have a tax attorney side to them as well. And then we work in concert as a team to help our clients that come to me. They'll bring some clients to me as well. We work in concert to do this overall plan that takes into account how are they going to take retirement money, where's the different things coming from, making sure their overall plan makes sense, but also protecting so that they can disinherit the IRS and not have the IRS be actually probably a major beneficiary when you think about it. If you've got a couple of kids and the IRS is taking 40%, they're getting more than your kids are.
Okay, so speaking of kids and everything else, what role do gifting strategies play in preparing for potential tax changes? Like, how can they affect high net worth individuals and make them use them efficiently?
So, because this estate tax limit we're talking about, the 13 million roughly that it is today, that's a lifetime exemption. So if you gift to your kids today, and there are some gifts that you can use outside of that, but they're pretty limited. Like right now, in this year, you can gift $18,000 a year to someone without having to use up part of your lifetime exemption. So if you're married, you can each gift that, you and your spouse, to each one of your kids and grandkids and move some money outside of your estate. But if you're fairly wealthy, that's not a lot of money to move out in any one year.
Hey.
And knowing that you're going to be losing half of the $13 million exemption, it's time to do that planning now to be able to use up that $13 million exemption as well, or at least half of it so you're not losing it, and then you'd still have your other half with $7 million left. But like I said, we also don't know that the $7 million will stay in place. So it's really a good time knowing that this fluctuation is going to happen, knowing the government needs to bring tax dollars in to deal with our deficits, to just put an overall plan in place that makes sense and covers you no matter what happens in the future.
So for those who are like charitably inclined, how can charitable giving be leveraged as part of an effective estate planning strategy?
Charitable giving is a great strategy. Not everybody's charitably inclined, but it's definitely something that we talk to our clients about. You can gift, say you have to take an RMD from your IRA this year. And rather than taking that gift, you can actually, or that RMD, you can turn around and gift it to a charity, which then means that you're not now paying taxes on it. So it's a way to pull money out of IRAs, 401ks, and gift them. But there's bigger foundations we create for many clients. We'll do what we call is charitable lead access trust or charitable remainder unit trust, and these are all they're geared towards charitable giving. And so you put money in, you still could use some of it during your lifetime, but then whatever's left over is going to go to charity and now be outside of your estate because you left it to charity. So someone that's charitably inclined, it just gives us more tools to deal with estate tax issues.
So you said being able to use some of that money in your lifetime. Are there limits or restrictions on what that money could be used for?
It kind of depends on how you set them up. There's many different ways to kind of figure out what you want to do with a particular client. And so the way we start most relationships is just to ask a lot of questions. Are you charitably inclined? What are you typically giving now? Do you want to leave a gift upon your passing? Like what can we set up to make sure you still, you're not tying up all your money so you don't have enough money to live off to your lifetime and do the things you want to do, but also to like set yourself up so you're lowering your overall taxation and disinheriting the IRS, and maybe you're helping these charities that really matter to you rather than that money going to the IRS. Or in other ways, maybe it's important that your kids get it, so we're setting you up in that way. A lot of people do family foundations. It's a great tool where you can set it up and you have family meetings. You can actually take a trip every year to go have this family meeting, get a little vacation in the process, choose which charities you want to, give money to that year. You're starting to teach your kids and your grandkids, which is even better when you can get 2 generations away or even 3 maybe, on how they're picking which charities they want money to go to, and really thinking about that kind of stuff. It's an amazing family tool for sure.
Okay. Well, all these strategies sound incredibly valuable. I know we've touched a little bit about uncertainty, but can you reiterate again why it's so important to start planning now rather than waiting to see what happens later?
I think it's really important to plan now just because we do have such a high estate tax limit that it gives us a lot more room to make changes today and use up the exemption that's really, it's higher than it's been in a very long time. And so for people that do have wealth that aren't taking advantage of that, it makes me sad because you're basically saying, okay, I'm fine with the IRS being a beneficiary of my wealth.
Yeah, it just doesn't sound like a good alternative.
Most people don't like it. There's some that don't care, and that's okay if that's them, but I would say most people, have worked really hard to amass what they have, and they want to make sure that that's there to take care of generations to come of their family.
Okay. So given your dual expertise as both a certified financial planner and a certified public accountant, how do you uniquely approach estate planning to ensure that all potential financial and tax implications are considered?
I think we just take financial planning to a whole nother level than what people typically see from their advisors. When you look at the ultra wealthy, they have a team of advisors that they hire, which probably costs them over $1 million a year. If you can afford that, great, then that's what most of those people have. But what we've tried to create with our office and our team that works together is something very similar to what the ultra wealthy gets with their own family office, is what it's referred to, but for people that maybe don't have their money or don't want to have a team that they're paying just to work for them. We work for multiple families at the same time, so we call them multi-family office is what we are, and we're able to work with high net worth individuals that don't want to have that whole team but still have a team that works together on their behalf, just not every single day of the year.
So break that down, because you mentioned family offices. What typical net worth level does somebody have the need or the ability to afford those kind of services? And then where is kind of your sweet spot with your multifamily or fractional family office?
Yeah, it's kind of funny because there's probably a line in the sand where someone should afford a family office. But will they? I guess is the question.
Yeah.
Because when you're looking at, do I spend $1 million a year every year to have this team for me? Or is there a team that I can use, because once you kind of get somebody on a plan, upkeeping it and things like this, yes, you're dealing with changes that come down the line from legal to tax to all the different aspects. But most people just don't want to hire a whole team and have to, it's almost like running a business really,
Right.
to have your own family office. So you're still the CEO, they're all working on your behalf, but you can still get something similar to that without the expense of it. So I would say anybody maybe above 50 million in assets, could potentially look at it, but you typically see it more with people 100 million or more.
Okay, so anything below that, you can benefit from these services without having to incur the cost of having every one of those specialists on staff full time.
Correct.
Okay. So for people who want to be prepared for these future changes that we're looking at, what would their first steps be towards tightening up their estate planning to protect their legacy?
Sure. So typically I have a complimentary consultation I do with people where they can get on the phone with me, kind of talk about what pieces they have in place and maybe what they don't have in place. And from there, we can usually come up with a plan that says, okay, here's the things that we would need to do from here. The next step is we usually gather some information about what assets they hold currently, how they're held and things like that. And then our team kind of comes together to come up with an initial overview and plan for what we see are the best steps or options for them. We present it to them, usually in a PowerPoint and things like that, in an understandable way. We don't, we're not using tax code and things like that so that people can understand what we're talking about, but we give them options. It's like, if you're charitably inclined, here are some of the things we could do. If you're not, here are other things that we can do. And we usually give them kind of a gamut of options based off of their unique scenario. And then they, from there, can decide which pieces they want to, enact and which ones they don't. And so really it's like we're acting as their executive team, and they're still the CEO. So they're just brought a lot of information. It's explained to them in a way that makes sense, and then they can pick and choose the pieces that make the most sense for them, and in the end, disinherit the IRS.
Okay. So what's the first step to reaching out to you? Where can people find you? How can they get in touch? How can they set up a meeting?
Sure, yeah. I mean, at the end of this, we can link the link to my calendar. Like I said, I do a complimentary consultation that's usually about 30 minutes or so, 45 minutes on the phone. We just talk through some items and things of where you're at, what do you have, what don't you have, and then, we can talk about what the process from there is to work together and to come to that plan or the overall plan for them. And then obviously there's implementation past that. Some people are like, I'm going to go implement with other people. No, I want to implement with you guys. We can do it either way, but we kind of charge as we go along for the different pieces. And it gives people a lot of peace of mind knowing that we're not forcing you into any one thing. We're going to give you a lot of advice in the beginning as part of that overall plan. And then you can decide how you want to go through and implement it.
Well, thanks for your time, and we'll put all of the pertinent details in the comments and the show notes or wherever they're looking at this piece of content at so they can contact you. Thank you so much for your time, and thank you for watching.